Hey, listener, we're going to be cracking open a prospectus that just dropped.
Wow.
Literally was released this week.
Fresh off the presses.
So fresh off the presses, we're among the first to really dig into it.
Very exciting.
And get this.
Okay.
It's for Roundhill's new S&P 500-based ETF.
Okay.
Ticker symbol XPA.
All right.
Now, you might be thinking,
Yeah.
another S&P 500 ETF.
Right.
What's the big deal? But trust me, this one's got everyone buzzing.
I believe it.
Why? Because they're aiming for a 20% annualized payout.
Whoa.
And they're doing it using options,
Okay.
which always adds a layer of intrigue, right?
Yeah, definitely.
I know prospectuses can be dense,
Sure.
so I've got our expert here to help us break it down
Absolutely.
and figure out if this thing lives up to the hype.
Yeah.
Before we even get started, I'm curious.
Okay.
What's your first reaction, just hearing that? 20% payouts on an S&P 500 ETF options involved. What's grabbing your attention right off the bat?
Well, I think 20% is definitely eye-catching for anyone,
Yeah.
especially for something that's tracking the S&P 500. That's certainly not something you see every day.
Yeah.
So I'm very curious to see how they're going to pull that off.
Okay, let's unpack this.
All right.
First things first, can you give us a quick rundown of what XPI is at its core?
Sure. So XP is an exchange-traded fund, or ETF,
Okay.
meaning it trades on the stock market, just like a regular stock.
Gotcha.
But what makes it unique is the strategy they're using to try and hit that 20% payout target.
Okay.
They're going to be heavily using something called FLEX options,
All right.
which are basically call options
Uh-huh.
on the SPY ETF, the one that everyone uses to track the S&P 500.
Ah, options.
Yeah,
Those always make things more interesting.
a little bit, yeah.
Just for clarity's sake,
Yeah.
can you remind us what a call option is in simple terms?
So imagine you have a coupon that gives you the right to buy a pizza for $10.
Okay.
Let's say the price of pizza suddenly jumps to $15. Your coupon is now pretty valuable, right?
I would think so.
Because you can buy a pizza for less than it's worth.
Yeah.
That's essentially what a call option is.
Okay.
The right, but not the obligation to buy something at a set price, even if the market price goes higher.
So XPAY is buying a bunch of these pizza coupons for the S&P 500.
Exactly.
Got it.
Yeah.
But how does that translate to giving me, the investor, a 20% payout?
Well, here's where things get interesting.
Yeah.
XPay is focusing on call options that are already in the money.
All right.
So in our pizza analogy, this would be like having a coupon for $10.
Mm-hmm.
When the pizza's already selling for $15,
Okay.
you'd make a profit the moment you use it.
I see.
XPay aims to capture that profit from in-the-money options, and that's how they hope to fund a big chunk of those payouts.
Okay, so they're buying options that are already set to make money.
Right.
That makes sense.
Yeah.
But something's still nagging at me.
What's that?
They keep saying this 20% is a target,
Right.
not a guarantee.
Mm-hmm.
What's the catch?
Well, you're right to be cautious.
Okay.
The 20% payout isn't some magical certainty.
Yeah.
It's based on the fund's net asset value, or NAV, at the end of each year.
Okay.
And they're aiming for a large portion of it to be what's called return of capital.
Return of capital. That sounds intriguing, but maybe also a little too good to be true.
Yeah.
Can you explain what that means for us regular investors?
Imagine you invest $100 in XPA.
Okay.
Now imagine they give you $20 back as return of capital.
Right.
It might feel like free money,
Sure.
but what they've actually done is lowered your stake in the fund.
Oh.
So you now effectively have $80 invested.
So wait, I'm getting money back, but my investment is also shrinking.
Yeah, essentially.
How does that work?
Well, the good news is return of capital usually isn't taxed immediately.
Okay.
So it can be a great way to lower your tax bill in the short term.
Right.
But there's a trade-off.
I was wondering when that was coming.
Because your investment has effectively shrunk when you eventually sell your XPA shares,
Yeah.
you could end up paying more taxes than you'd expect.
Okay, so it's kind of like a delayed tax bill.
Yeah, you could think of it that way.
I'm starting to see how this return to capital thing is a bit of a double-edged sword.
Exactly.
Okay.
It's not as simple as it might seem on the surface.
Right.
It's definitely something you'd want to discuss with a tax advisor to fully understand the implications.
So we've got options,
Mm-hmm.
a big payout target, and this whole return of capital wrinkle.
Yeah,
This XPA thing is already shaping up to be more complicated than your average ETF.
for sure.
I'm guessing there are some risks involved too, right?
Oh, absolutely.
Prospectuses are usually full of those little warnings.
Okay, well, the prospectus certainly doesn't shy away from the risks,
Yeah.
and there are a few key ones that stand out.
Okay.
For starters, remember how XPA is relying on those FLEX options,
Uh-huh.
those pizza coupons? for the S&P 500.
Right, yeah.
Well, even though they're focusing on options that are already in the money, there's still a chance things could go wrong.
Oh, yeah, because even a pizza coupon isn't worth much if nobody wants pizza anymore.
Exactly. The value of those options can fluctuate.
Yeah.
And if the market takes a sudden downturn, XPA could end up holding options that are worth less than they paid for them. This could eat into their returns and potentially even impact their ability to hit that 20% payout target.
So there's a risk that the options themselves could lose value.
Yeah.
But isn't there also a risk just in the fact that they're using options at all? Aren't they more complicated than just buying and holding stocks?
You're absolutely right.
Yeah.
Options are inherently more complex than stocks.
Okay.
And they come with their own set of risks.
Right.
The prospectus talks a lot about liquidity risk, for example.
Liquidity risk.
Yeah.
Remind me what that is again?
So think of it like this. You have a rare baseball card that you want to sell.
Okay.
Finding a buyer who's willing to pay a fair price might be tough, right?
Yeah, it could be.
Because it's not something that's traded very often.
Right.
That's kind of what liquidity risk is all about.
Okay.
It's the risk that you won't be able to easily buy or sell an asset at a reasonable price.
Gotcha.
And options, especially certain types of options, can be less liquid than stocks.
So if XP needs to quickly sell some of its options, it might have to accept a lower price,
Right.
which could hurt its returns.
Exactly. And that's just one example of the complexities that come with options trading.
Yeah.
The prospectus goes into detail about various other option-specific risks, and it's definitely worth reading carefully.
What are some other red flags that investors should be watching out for when it comes to XPA? Anything else jump out at you from the prospectus?
One thing that caught my attention is the risk that they call FLEX option volatility risk.
Okay.
Essentially, this means that even small changes in the perceived volatility of the S&P 500 can have a big impact on the value of those options. Volatility refers to how much the price of an asset swings up and down.
Okay.
A highly volatile asset is one that experiences big price swings, while a less volatile asset has a more stable price.
Right.
And the thing about options is that their value is very sensitive to changes in volatility.
I see.
Even a slight increase in volatility can cause the price of an option to jump significantly.
It's like they're trying to surf on a wave,
Uh-huh.
but the wave is constantly changing size and shape,
Right.
making it really hard to stay balanced.
That's a great analogy.
Okay.
And to make things even more challenging, the volatility of the S&P 500 isn't always predictable.
Right.
It can be influenced by all sorts of factors, from interest rates to global events.
So XPAY is essentially exposed to all these external forces that could affect the volatility of the S&P 500, and that could throw a wrench in their whole option strategy.
Precisely. It adds another layer of uncertainty and risk that investors need to be aware of.
Okay, so we've got liquidity risk, volatility risk, anything else investors should have on their radar.
Well, there's one more risk that's specifically tied to XP's unique approach, and it relates to that 20% payout target we keep talking about.
Oh, yeah, there was something about that, the prospectus.
Right.
They called it managed payout risk, right? What was that all about again?
It boils down to this XPA is committed to making those distributions
Okay.
regardless of market conditions.
Right.
And to do that, they might have to dip into the fund's principal.
Wait, dip into the principal?
Yeah.
You mean they might actually be returning some of my original investment to me as part of that 20% payout?
That's exactly what it means.
Really?
And while it might sound appealing at first,
Sure.
who doesn't love getting money back?
Yeah.
It can actually erode the long-term value of your investment.
So it's like they're giving me a piece of my own pizza back and calling it a bonus topping.
You could think of it that way. And it's a key difference between XPA and a lot of other ETFs that only pay out dividends based on the actual income generated by the underlying stocks.
Right.
With XPA, you have this additional risk that the payouts could be coming partly from your own pocket.
Right. So we've got potential pitfalls with the options themselves, the added complexity of options trading, and this whole managed payout risk that could eat into my principal. It's starting to feel like XP is walking a tightrope.
It's definitely a more intricate and potentially riskier approach than a traditional index tracking ETF.
Right.
And that's why it's so crucial to understand the mechanics and the risks involved before jumping in.
So for all our listeners out there who are considering taking a bite of this XPA pizza, make sure you understand what toppings are actually included and what you might be giving up in return.
Right. So the total operating expense ratio, or TER, is 0.49%.
Okay.
Which at first glance might not seem too bad
Yeah.
compared to other actively managed ETFs.
Right.
But there's a twist.
I knew there had to be a twist. What is it?
They're using something called a unitary fee structure.
Okay.
Basically, Roundhill, the company behind XPA, is covering most of the fund's operating costs.
Oh, wow.
Beyond their management fee.
Okay.
Things like legal expenses, administrative costs, even marketing.
Huh?
They're shouldering those burdens to keep the expense ratio lower for investors.
Yeah, that sounds pretty generous of them, so more money stays in my pocket, right?
Potentially, yes, lower fees mean more of your investment can potentially grow.
Okay.
But it also raises a question about sustainability. Can Roundhill keep absorbing those costs indefinitely?
Yeah.
Especially if the fund doesn't grow as quickly as they expect.
Ah, so it's kind of like a discount that might not last forever.
Exactly. It's something to consider. If those costs start to eat into Roundhill's profits, they might have to raise the expense ratio down the line.
Okay, so keep an eye on those fees. Got it. What else do we need to know before deciding if XP is worth the risk?
Well, remember that whole return of capital thing we talked about?
Uh-huh.
That has some important tax implications that are worth understanding.
Yeah, the return of capital sounded appealing at first, but then we learned it's not quite as simple as getting free money. Can you remind us why that matters come tax time?
It all comes down to your cost basis.
Okay.
Which is essentially what you paid for an investment.
Right.
When XPA gives you some of that money back as return of capital, it actually lowers your cost basis.
So if my original cost basis was $100 and I get $20 back as return of capital, my new cost basis is $80.
Exactly. And when you eventually sell your XPA shares, you'll be taxed on the difference between your selling price and your adjusted cost basis.
So even if I only made a small profit on the sale, I could end up paying taxes on a much larger gain.
Right.
Because my cost basis has been reduced.
That's the potential downside. It might not seem like a big deal now, but it can make a difference in your overall returns, especially if you're holding XPA for a long time.
It's making my head spin a little. It's definitely a good reminder to talk to a tax advisor before diving into something like XPA.
Absolutely. Taxes can be complicated, and it's always good to get professional advice.
Okay, so we've got fees, we've got taxes. Anything else standing out to you from the prospectus?
There's one more thing that's worth highlighting, and it relates to the fact that XPay is basically mirroring the S&P 500. We need to talk about concentration risk.
Concentration risk? What's that?
It's the risk that comes from having too many of your eggs in one basket. In XPA's case, because it's tracking the S&P 500, it inherits the same concentration risks as the index itself.
Meaning if one sector or a handful of companies perform poorly, the entire fund could be negatively impacted.
Exactly. And the prospectus points out that as of June 2024, the S&P 500 was heavily weighted towards information technology.
Okay.
So XPA will likely have a significant exposure to the performance of tech companies.
So anyone investing in XPA needs to be comfortable with that level of concentration and the potential risks that come with it.
Absolutely. It's all about understanding what you're getting into and making sure it aligns with your overall investment goals and risk tolerance.
Right. It's like choosing a pizza with a lot of toppings sounds delicious.
Yeah.
But you need to make sure you actually like all those toppings.
Great analogy.
All right.
Now, before we wrap things up, I think it's worth mentioning the people behind XPA. The prospectus gives some insights into the experience and background of the portfolio managers, and it's quite impressive.
Yeah, it's always reassuring to know that the people managing your money know what they're doing.
Right.
What stood out to you about their expertise?
Well, they have a deep understanding of both ETFs and options trading. They've got years of experience managing complex options strategies, and they seem to have a very data-driven approach, which I always appreciate.
It sounds like they've got the right tools and experience to navigate the challenges that come with a fund like XP.
Yeah.
It's not a guarantee of success, of course, but it's certainly a good sign.
For sure.
Okay, listener, there you have it. We've dissected the XP prospectus, explored its unique features, the potential risks and rewards, the fees, the tax implications, and even the team behind it all. Investing is a personal journey, and only you can decide what's right for your portfolio. But if you're considering XPA, definitely read that prospectus carefully.
Well, good idea.
And maybe chat with a financial advisor to get their perspective.
Great advice. Knowledge is power, especially when it comes to investing.